Hey everyone, thank you guys so much for joining us. We're going to wait just a few minutes before we get started. We'll get started at 12:02. That way anybody that has registered has an opportunity to join us. Thank you so much for being on time and ready to go. We're super excited. Sean, this is his first webinar with us, and we normally have this small window where we allow any other registrants to just join us as they come on, and I can see on the side as more people add in. So we're just going to wait just a few more seconds before we get started, okay?
Works for me. Do we need to have Wade sing some music or something, like some play-in music while we wait?
We could play background music, but you do not want me to sing.
Yeah, I've given it's just to save everybody. That's my gift to them. Sean's not singing.
So the numbers are still going up. We're going to wait just another minute. We've got about half of our registrants on, so just a little bit longer, okay? But we can all try to do a song if you would like.
No, it's okay.
Okay, all right. It's probably best for everyone.
Yeah, it's safer that way. Yeah, there's a reason I'm a CPA and not a musician. It's based on playing your skills.
All right, it's 12:02. Thank you guys for joining us. We're so excited. We have our featured speaker today. It's going to be Sean Duncan. He's the president of SMD Consulting and Accounting. And we're going to be going over little known tax benefits. If you're joining us from Sean's group and you're not familiar with Catalyst Funding, I'd like to give you an opportunity to know a little bit about us. We are a hard money and permanent financing option for you. We offer the widest range of products in Houston. We have one point of contact for all loan officers, and all of our loan officers are fully licensed. We do one credit pool for multiple products, and we have experience with over 800 fix and flip projects in the Houston area. We offer one-on-one consultation, and I know right now with everybody being home, it's great that we still offer this. We can do it through our secure web portal on Teams. If you have any questions, be sure to write down our information, info@catalystfdg.com. That email is going to be in the last slide of this presentation as well. Now we'll go ahead and jump in, unless Wade, did you have anything you wanted to add?
The only other thing I did want to mention is I know Sean is up in Dallas, and we are lending in all the other major metros throughout Houston at the moment. So that includes San Antonio, Austin, and Dallas. So if any of you are either residing or investing there, we'd love to hear from you as well.
Oh, Jiminy Crickets. This is our disclaimer. This presentation is for general information only. No documents or estimates represented here are going to help you with, or they're not going to represent your investment performance. Make sure that before you get into any investment, you do your own due diligence, and we are happy to provide you this information for an educational purpose. So our featured speakers today are going to be Wade. He is our founder and president. He began his career in 2005, so we're going on a little over a decade here. Lots of experience. He's also a licensed. Wade, why'd you make that face? Almost two.
No, that's actually not an accurate number, and I'm not sure how that got mixed up.
Oh, really?
2005.
Oh, okay.
It's actually 1999, but nonetheless.
Oh, okay.
Yes.
You need to update that. Okay. Yeah. So 2 decades then.
Sad but true, yes.
Oh, okay. Didn't mean to say it like that. Wade has held many positions in national lenders. He is a mortgage loan officer as well. He has his license, and we are super excited that he's on here today to talk with Sean. Sean is the president and founder of correct, Sean?
Founder.
Of SMD Consulting and Accounting. Sean, is there anything that you'd like to share with us?
No, actually, I think I'm the older fart of the two of us. I actually started my career back in '95, so I'm coming up on 25 years of
25, yeah.
Accounting experience. I started my firm in 2006, so I'm probably closer to Wade's fake number on there than the reality.
Awesome. So we're going to go ahead and get started. Sorry, my computer's being touchy today.
We can wing it. We can jump all over the place. I'm happy to answer any questions as they get going. So.
This is our first slide, but that is a good point. If anybody has questions during the webinar, feel free to hit the chat box or the question icon on your right-hand side and let us know. We'll answer the questions in the last 10 minutes of the webinar. Thanks, guys. Yep. All right, Sean, take it away.
Okay, well, I don't have a prepared speech or anything, so guys, yeah, if you have questions, throw them in there because it's actually a lot more valuable to you if you have questions and we're addressing that rather than just some random speech. Because I can go for a good 5 or 6 hours if you really want to, but who wants to listen to accounting that long? Now, so a couple things that Wade and I had talked about that would be interesting to y'all is understanding what's going on with different deductions, and the PPP loans is where we wanted to start. That's huge. It's a hot button right now. And there's so much confusion, and never mind the fact that there was confusion when they rolled it out. I mean, they were literally changing the rules multiple times a day. I mean, changing the rules. How does it work and what can you get? First thing I want to point out, the PPP loan is not the same thing as the EIDL loan. There's actually 2 loans that are out there that can be confusing. Happy to clarify that stuff if anybody's interested, but the PPP is the Paycheck Protection Loan. And that's the one that just changed recently. High points. Essentially, how does the loan work, which is, I guess, where the next slide kind of hits the bullet points. How the loan works is essentially this. In theory, you have already, and there's actually still money left, by the way, guys. So if you haven't received your PPP loan or requested one, you can go do that. You can go talk to your lender. So you start with going to your SBA preferred lender. So not all banks are an SBA preferred lender. How does the loan work? You go in and say, hey guys, need some money. I need at least or up to as maximum of 2.5 times my monthly payroll. And there's limits and all this stuff. If your monthly payroll adds up, 2.5 months adds up to $100,000, you can borrow a $100,000 loan. It is a loan. I know this is where the forgiveness and the grants and all this stuff gets really, really confusing. Starts off as a loan. You are borrowing money. Highly expedited process. So if you've ever borrowed money from the SBA, it can be a complete and total beatdown. You're going to get caught in 6 and 8 weeks of paperwork, and you've got to put 20% down, and then you're going to pay $10,000 in fees. All of that changed. This is a very unique product. People were getting money in a week and a half. And we're talking, I had a client that got $750,000 in 7 days. That completely changed the dynamic of their firm and allowed them to keep all their people employed. So first you request the loan. There's the process, there's paperwork, and there's submission and documentation that has to go with it. Your banker will handle that. The plan, now this is the part that's changed, and this is where confusion happens. You are supposed to, under the original provision, spend at least 75% of that money on payroll costs in the 8 weeks that followed the day the money showed up. So already we got complexity, right? We got timelines and deadlines and percentages. They just changed that rule. Now you need to spend 60% of that money on payroll-related costs in 24 weeks. Huge difference, complete game changer. If you own a company, now we're obviously talking to real estate investors, it's a little different game here, but if you own a company and you have employee costs, 24 weeks to spend that money is pretty easy to do. Other allowable costs like mortgage interest and financing interest and utilities and rent. So for the typical operating business, that was what it was designed for, and you rock and roll from there. As you approach the deadline, now it's 24 weeks and not 8 weeks, there is a horribly painful set of calculations. You shouldn't have to worry about that. You should have a CPA helping you with this. I beg you, please have a CPA do this, because the complications inside of it to get the forgiveness, to prove that you spent the money the right way, it's a lot of work. I mean, expect that you're going to pay your CPA 3, 4, 5, 6 hours to do this amount of work because of the way they've built these schedules. And I'm not going to bore you with that. That's not what the scope of it is today. But let's just say you get it forgiven. You get the entire $100,000 forgiven because you submitted your paperwork correctly and it got approved. That turns the loan into a grant. You don't owe it back. It's done. Congratulations. Here's your money. You get $100,000. And here's the catch, though. They've been advertising over and over and over again as a tax-free grant. Technically, it's true. But see, the grant is taxable. But here's the gotcha, and it's not a bad deal. It's not a horrible deal. I was kind of angry about it when they played this game. Whatever expenses you use that money on, they're no longer deductible. So I took my $100,000 in, hooray, I got $100,000 non-taxable. It's all mine. I spend it on payroll to keep my people employed. Now your payroll expense for that 100 is no longer a tax deduction, which is basically the exact same thing as making the $100,000 taxable. If you take a $100,000 tax deduction in your 37% bracket, that's $37,000 that you saved. But if I did, it's the same math, guys. It's the same math. So even though they say it's non-taxable grant, don't get freaked out about it. You just lose the tax deduction. But here's the easy math. Would you rather receive $100,000 and have to give $37,000 or whatever your bracket is back to the IRS, or not get the $100,000 at all? It's pretty easy. Now, the forgiveness part, it is highly likely that not all of it's going to get forgiven. I'm telling most of my clients between 5 and 20% won't get forgiven because the math and there's gotchas and there's all these rules. If it's not forgiven, it's kind of easy. It's a 1% APR loan over 5 years. 5 years. So if you borrow $100,000, they don't decide to forgive $20,000, you have a $20,000 loan for 1% over a 5-year term, and you can pay it whenever you want. There's no early prepayment penalties. So I think I might have a banker nearby that says that's a pretty good term. So it's not the end of the world if it doesn't get forgiven. Just know that that's the mechanics of it. And that's sort of the key to this. When on here we put what are the tricks and traps, the tricks and traps is the math. Did you use it right? Did you keep the same number of employees? There's all these safe harbor rules. How does it apply to the real estate professional? Originally, the rules did not allow this to go to the real estate investor. However, they changed this and they gave a couple safe harbor rules. And again, not going to overtax nerd this. First of all, if you're a real estate professional and you qualify under the real estate professional rules, and you guys probably know what all that is. If not, let me know. There's a webinar I did a while back, but also other cheat sheets I can send out. You get it. If you're not a real estate professional, they have a safe harbor rule that has a whole bunch of things about did you spend enough hours and yada, yada, yada. So there is a possibility that the real estate investor could also get the loan and get it forgiven. But just for now, big picture, starts as a loan. You can get most of it, if not all of it, forgiven. When you do get it forgiven, it's not taxable, but you lose your tax deduction, so it might as well be taxable. And then they're just assume that part of it will be a loan, and the loan is an amazingly favorable term. Hopefully that helps explain it. Wade, anything you feel like I missed that would help on your side of the world that I should clarify?
No, I think that's a very accurate description of my understanding of it. You're much more of an expert than I am, but I think it is complicated. As you said, getting advice is important, just like most of these situations. Oftentimes a little bit of a cost to ensure you do it right is much better than doing it incorrectly and costing yourself a lot more money.
Yeah, and I can't stress it enough. Call your CPA up. Not all CPAs are experts on this, but that's your first go-to, is solicit their advice, solicit their understanding. What does it mean for your taxes? What does it mean for your cash flow? Should you or shouldn't you even borrow the money? We had the panic and chaos, by the way. COVID hits and everybody's businesses and doors are closing and things are happening. This was a lifesaver for a lot of folks. I mean, if you imagine you're my client and you get $750,000, that bridges your cash flow pretty nicely for a short period of time, depending on the size of your business. So it was a wonderful little life preserver. It wasn't intended to change the world, but it was really nice. But then you must solicit a tax professional to help you with the forgiveness and the banking thing. By the way, and just a sidebar, if you happen to use ADP as a payroll company for yourself, if you happen to be at a company, they've already generated auto reports to help with the forgiveness part. I've been working closely with their corporate on this, on developing tools. So a lot of it may be automated, and that will speed it up and make it easier for a tax preparer.
Excellent.
Cool. Oh, the favorite part. So if any of you guys are part of Lifestyles Unlimited, this is sacrilege, and doesn't always mean no entities ever. So entities do apply for the real estate investor. We're going to stay on the real estate investment side of the world here. If you have operating a current business as a medical practice, a manufacturing plant, of course, reach out. We're happy to explain what it means for you. But on the real estate investor side of the world, if you're going to go buy one single family house, please do not set up an entity. Now, if you talk to a lawyer, they're going to disagree. I'm not a lawyer. I don't pretend to be one. If I give you legal advice, you heard me wrong. You're supposed to talk to your lawyer, not listen to me, because I'm just some weirdo CPA. But entities' purpose are both legal and tax. It's not or, it's both. So you need to always consider what this is. So what are the entity types? In the IRS's eyes, there's basically 4. 5 if you want to count all the trusts. We're not talking about that. Trust is a whole different set of rules here. There's the sole proprietorship, the partnership, the S corporation, and the C corporation. Those are the 4 taxable entity types according to the IRS. Now, if you're wondering where does an LLC fall in that, you're not going to be the only person that wonders. LLCs are state designated entities. So when you form it, it's based on those states' rules on what your filing requirements are, what your legal protection is, how you can do ownership, but you can form them. But what the IRS then says is, okay, that's cute. We love that you got this LLC. Good for you. But which of those 4 are you? Your LLC gets to pick which one of those 4 entity types it's taxed as. And right there, you start with strategy. If you're a real estate investor, knowing how big your real estate enterprise is going to grow changes the strategy and the advice. Every single client should have a proactive conversation with their tax preparer. And hopefully it's not preparer, hopefully it's tax advisor, because that's really what the CPA is supposed to be doing. You set up a structure that allows you to maximize the tax benefits, maximize your entity and asset protection, and by the way, minimize your audit risk. And there are tools that are out there. So when we marry these things up, that's what I'm looking at. That's what my team is looking at, is how do we set this stuff up? Now, entities have a dramatic impact on lending, and we'll probably talk about that here in a little bit as well. The major differences, just to give you the super high points, and I actually teach an entire class just on entities. Sole proprietorship is you. You started your business. Congratulations. You start selling lollipops to your neighbors and making money. You actually are right then a sole proprietorship. It has nothing to do with actually any formal organization. Doesn't mean you filed anything. It's just an entity. When you start your first real estate property, we're going to say single family. Multifamily is a partnership thing. We'll talk about that in a second. You are a sole proprietorship. You may not have formed something, but you actually have a business. The very first property you invest in, you have a business. Now you have to start treating it that way. Sole proprietorships are easy. They're inexpensive to start up. Their compliance is really, really pretty straightforward, but they're not really tax advantaged as you start getting higher levels of income. And then, of course, if there's no entity, there's no LLC sole proprietorship, it's just sole proprietorship, you also have a ton of liability and exposure. So you always have to consider that. Partnerships is basically the same thing as a sole proprietorship, it's just there's more than one owner. And there's general partnerships and limited partnerships. Like I said, teach lots of classes on this. Partnerships, though, is where you see the multifamily investments. When you invest in a multifamily property, you're not investing in the property. You're investing in the entity that owns the property. The property is the underlying asset. So now you actually own part of a partnership. When you get your distributions and all the money coming out and notifications, there's a whole process using K-1s and cash flow. Explain that stuff later. But the partnership is a multi-owner organization. And whether you're a general partner or a limited partner affects how you're taxed and what your legal liability exposure is. You must understand that. Before you write a check to a multifamily investment, you need to really understand what is it you're buying. That's why 1031 exchanges don't work as often in multifamily investments, because you're not 1031ing a building, you're 1031ing a ownership interest in a property, and guess what? That's not allowed. The IRS changed the rules. Third entity type is called an S corporation. It has the lowest audited entity type of all types. The IRS audits that one the least, but it has more compliance. So you get this trade-off: lower audit risk, higher asset protection, but you get a little more cost. And so when you start considering S corps, you need to be sure that there's a trade-off for your ROI. And then C corporations is like you've had a new child. It files its own tax return, it does its own thing. You might as well not exist. You just happen to be a shareholder in it. You can be the 100% shareholder, but you are different and separate from that entity. And what that means is how you interact with it is different. C corporations are amazing for asset protection, but they have a double taxation impact. You get popped with 2 taxes every time you take money out. You need to be sure you know that. And I'm keeping it simple, so if there are any CPAs listening, I know I'm keeping this super simple, and there's a lot of if-thens. I'm aware of that. Taught a lot of classes on this, but just know that all 4 of these entity types have advantages and disadvantages. What your circumstance is matters on how you decide to choose. Now, do you even need an entity? Maybe, maybe not. I would tell you, if you have one single family, no entity. You invest in 1 multifamily or 2 multifamilies, please don't overcomplicate your life. But if you're planning on building something that has, I'm gonna go ahead and push 10 single families and have 5 multifamilies, I might even do an IRO in this, please, before you start moving money, get the foundation laid. This business enterprise you're building is just like building a house. If you don't have a foundation and your entity and organizational structure is the foundation, you could be wobbly as things build up and go from there. I'm actually sitting right here next to me. There's a stack of documents from a client, a prospect. I'm reviewing their organization and how they got stuff set up, how they've structured themselves. If we just fix the structure that has been wrong for the last 5 years, we'll save them $15,000 a year in taxes, reduce their audit risk, and their fees to the CPA that's preparing tax returns will drop by $3,000 a year. They just have too much mess. We're going to clean up the mess and save them CPA fees and taxes, and that's before we even get cute with strategy. If they had just done this from the start, think about that. For 5 years, this is money they've wasted. 5 years times 18,000. I don't know anybody else but that's a lot of vacations I could take with $18,000 a year. Keeping that stuff in mind and being proactive and knowing where you're going, massively important. How do you determine, of course, is talking to your CPA. And then should you form one for yourself? 99 times out of 100, please don't form it yourself. Now, there's exceptions. There's cheat sheets and there's guides. But when people go to try to form it themselves, I can't tell you the number of times you just formed it wrong. Checked the wrong box, opened the exposure, formed it in the wrong state. There's a lot of stuff you'll read out there that says you're supposed to do a Nevada Corp or a Wyoming Corp. Hold on, that may not apply to you. And LegalZoom will take your order. You go form yourself a Nevada Corp and open a property in Texas. You now actually have to register in Texas and it's more expensive. Now you've got 2 filing requirements and not just 1. So understanding the rules. Now, like us and most tax preparers and CPAs and advisors and lawyers will tell you, sometimes we'll just say, yes, you can do that yourself, but at least you get the advice ahead of time on how to handle that. So please don't go just forming it. And by the way, universal rule for you. Google is a big fat liar. It lies. You don't know when it's telling you the wrong information. So hold on, turn to the professional. You wouldn't, WebMD ticks off doctors just like Google ticks off CPAs. Clients will go off and prescribe themselves something, or patients for doctors will go off and prescribe themselves something, and then they go to the doctor and the doctor goes, oh, that made it worse. Collaborate with your professional. Collaborate with the person that's been trained on it. I mean, I've been doing this for 25 years, which is horrible to say out loud, but I might have accidentally picked up something along the way that is unique and niche to what I do. In the same way I wouldn't go to my doctor and tell him what to do, we collaborate and we ask questions and I make my decisions, but I rely on their expertise. I'm not going to go try to figure out lending. I have to go to the lender to ask them questions on how these rules work. We collaborate. We don't just say, here's what I Googled, this is what you're going to do, because it may not fit. Does that help a little bit, Wade? Do you think we're on track there?
Absolutely. Absolutely. I think we've covered that one well. Well, what is our next slide here, Destiny?
It's coming up. So this one is, there's bullet points on the next slide.
This is a gotcha. So for single family, it's always interesting. Is a lot of clients will come in and say, okay, look, I've got $100,000. I keep getting these email blasts that say that the cash out of pocket's $20,000. Oh my gosh, I'm going to go place offers on 5 houses. Well, one, I think Wade probably just had a stroke hearing that right away, just going, oh, whoa, we got to do lending. You got to have cash flow. The most important thing to understand, and again, and I'm going on the lifestyles model, but you can be in part of other organizations or just doing this yourself and going and hitting MLS. The cash out of pocket, particularly when it relates to hard money lending, does not mean that's the cash you need. You actually need more. So you get an email blast and it says house purchase price is $125, expected renovation is going to be $50,000, and the ARV is going to be $225. Hey, congratulations, you're going to get $50,000 of capital gain on this bad boy. That's the way to go. Oh my gosh, the cash out of pocket's only $20,000. Hold on. You have $50,000 of renovations. So here's how the CPA world, the cash flow world works, and this is definitely where Wade will get to jump in on his, and I'm not just going to dominate and keep rambling. When you make your offer, you go, I'm ready to go, and you get started. If you have hard money lending on this thing, because they're going to lend you up on that ARV, they're not handing you $175,000. The $125 will be there to make the purchase. The $50 is a reimbursement. So think about this a second. You're about to do $50,000 of renovations. I'm going to change the number to 60 just to keep the math easy. $60,000 of renovations. When you reach the 1/3 mark of your construction, $20,000, you're turning to your contractor and you're writing a check. You're writing a $20,000 check to your contractor right then for that renovation. Then your hard money will get reimbursed after everything's validated that you actually did the work that you said you were going to do. They're going to reimburse you for that 20. But see, here's what happens. If you only had $20,000 out of pocket on this deal and you only had $20,000 in your bank account, you're out of money. The deal stops. If you've got to rent a hammer, you don't have the money to rent a hammer. You're done. Your deal is over with. We know the reimbursement's coming, but you don't want your contractor stopping because you ran out of cash because you can't pay for something. My rule of thumb is whatever it says the cash out of pocket is, have at least twice that available. Doesn't mean you're going to spend it. And when all the dust settles, you're going to get back the money. You're going to do your $20,000 submission, you're going to get your reimbursement. Your next $20,000 submission, you're going to get your reimbursement. And it moves beautifully. And this is like Wade and I have worked together on some of my single families. It works wonderfully, comes quickly. But see, if I'm out of cash before I can even get that money, then it creates panic and chaos. Or you can have what happened on 2 of my houses. The contractor was kicking rear end. He was doing great. We did the first one, we got our draw, and we submit for our draw. And I'll be darned, the guy finished the entire project. We didn't even get to the second and third. It just became the full $40,000. I had to stroke a $40,000 check, and then Wade's team sent us our money back, which was wonderful. But see, if I didn't have the 40, the contractor wouldn't have got paid. The contractor doesn't get paid. They can't do the reimbursement because they're reimbursing what you paid. Plan your cash flow. If you have 100,000 and you can find 5 houses that have 20 out of pocket, stagger them. Because also, if all your money is deployed, I mean, what banker wants to lend to anyone that has no cash in the bank? I mean, there's too much risk associated with that. So understanding that one reality has dramatically changed a lot of the plans for my clients and folks that just didn't realize it because it's not obvious when you're seeing the blasts. So if you just go with the rule of thumb, whatever the cash out of pocket is, it's 2 times. There's always surprises on houses, always. The water heater you thought was going to be perfect because the inspector said it was beautiful, breaks 2 weeks after the tenant moves in. The ARV comes in a little bit different at close than you thought it would be. That's life, guys. That's just the real world. Be ready to have your buffers. Don't over leverage yourself. Cash flow dominates every decision. You have to have cash. If you don't have it, game doesn't get played and you're done. And if it means you have to save up money for another 6 months before you can do your first house, please do it. I would rather you wait 6 months to do your first one than to run out of money and then now you don't have anything. You have no cash and you have no house, and then you're in, up a creek. So anything, Wade, you should add on that side, because you're the bank expert?
Yeah, definitely. I have a few things to add there. First of all, a lot of contractors require money up front. In your scenario, they did the first 20,000 of work and you reimburse them. That's a great scenario if you can get it, and it's all negotiation. I encourage you to give as little to the contractor as possible up front, because you're just taking a little bit of risk with that. Obviously, if you're getting a referred contractor from one of the quality networking organizations out there, including Lifestyles, and it's a lot more safety and security, but you do want to be cautious about how much you give them up front. Another quick point is that we do not have a minimum $20,000 per draw, so you could take more draws than that. And so I know you were just giving an example, but just to clarify for the new people, you can do smaller draws than that. And then the last thing I'll mention is that we do not require proof that you had paid the contractor up front. That's not something that we require. We document that the work is done either by one of our internal inspectors or a third-party inspector, and then we review that inspection report. So you can tighten up that time frame or even be a conduit for money in some circumstances. But what I will agree with Sean, those contractors generally pay their people on a weekly basis. They want to be paid quickly so they can keep their people happy. And if you have a good contractor who is kicking butt for you like Sean's was, the last thing you want to do is withhold money for a long period. So I think his scenario is right. Generally, you are paying them, you got a little bit of float time, and then we get you your money back. So understanding how much you got to bring to close for hard money, and then your operating capital to keep that project going, it's just an important factor.
Yeah, and then when you refinance it, because the expectation is you have your hard money lending and then you refinance to a conventional, that's when the dust settles and the total out-of-pocket number shows up. Whatever happened as money's shifting around while you're doing your construction, when the dust settles, you look up at the numbers and go, oh, look at that, I put 21,000 out of pocket. Well, that's not too bad because I was thinking 20, not a bad deal. Just know that between point A and point B, there's a lot of stuff that happens in that dance, and be prepared for it. And talk to your lender, talk to your CPA, talk to your mentor, understand and work with your contractors. There's a lot of team members that are going to be there to help you understanding and work with you on how this happens.
Absolutely. I think we're ready for the next slide there, Destiny. Thank you.
Wade, I'm gonna let you go on this one because I know this is near and dear to your heart.
Yeah. So, and we sometimes, a CPA and a lender may have slightly different primary objectives, right? I think the primary objective of a CPA is to help you ethically reduce taxes and to improve your business operations from that perspective. Our perspective is to ensure that you can get qualified for as many loans while limiting your taxes. But they may not always align perfectly. We do see a tremendous amount of people who may write off an expense, in other words, 100% of their repairs in year one. If you think about that $60,000 example that Sean just provided, that means that you are expensing $60,000 on a project where you may only be cash flowing, $300 per month on the project, and there's no way that you're going to outrun $60,000 in expenses in year one. In addition to that, even with the total rents that are provided, Fannie Freddie requires us to take a 25% vacancy rate out of that number, so you're actually only getting 75% of your rents as credit towards your DTI. So there are alternatives that still give you the same tax benefit, only it's over a more elongated period. So you can amortize or depreciate those expenses. Then you are able to add that back each year in which those depreciated expenses are on your tax return. And that is really the approach that we recommend if you're going to be adding a significant amount of properties. You can potentially amend your taxes if you've made that mistake, but it is expensive and it can take some time. So we really encourage you to talk with your CPA up front. As Sean mentioned earlier, have a plan. say, I want to add 10 properties. So I need to ensure that not only do I limit taxes, but I continue to qualify to add these properties from a Fannie Freddie perspective. That's not the only product we have. We do have some products that do not require a debt to income evaluation, but they are not going to be the absolute best priced products. And as most mentors will tell you in this space, you want to get the best price while you can to increase your cash flow and limit your out of pocket.
Yep, absolutely. And if you think of it this way, there's competing needs here. If you were going to just buy your regular primary home, this happens all the time, by the way, for business owners. If you're about to buy a house, or you know you're going to buy a house in the next 2 to 3 years, and we do everything we can to make you look broke on paper, we depreciate, we expense, and your trip to Vegas, it looks like a business conference, and not suddenly you have income of $10,000 a year for 3 years running, and then you go to your banker and say, I'd like to buy a $750,000 house, just your primary house. We're not even talking investment. And the banker sees you make $10,000 a year, and then you lean over and go, that's okay, I actually really make more than that. Is that banker going to listen to you and say, oh, so you're going to lie to the IRS, but of course you're telling me the truth? Which one is it? There has to be consistency. So a lot of times what we'll do is, just on primary houses, not even talking investment, we will go ahead and help the client bite the bullet on paying some more taxes for a year or two to boost up their income so that they can close on their house. The next year we can go bonkers and go crazy with deductions. There's strategies on timing that goes with this. But if you're going to be a real estate investor, you're always going to be in the lending game. So there's this delicate balance. We don't want you to pay any more tax than you have to, but we need you to show enough reasonable income so that you can borrow at the favorable rates. Because no one wants to pay 25% interest rates when they could have gotten 4% just because, oh, I'm broke. No one wants you to have to put $500,000 of a CD in a bank account as collateral just so you can borrow the loan for a house, just because of the way you did your tax return. So go on the assumption, if your game is, I'm going to be a real estate investor, this is going to be part of my lifestyle on how I'm going to build this thing out, know that you're always going to have to show some reportable income, and coordinating with that lender on what is the magic number. Because honestly, when you get to the end of the year, you're deciding what to write off, we can talk to the banker about, okay, next year we're thinking about doing 2 houses. How aggressive should I be? What number do we need to show to at least be favorable? That can be done. It's not tax fraud. It's tax management. It's strategy. It's planning. You do not have to deduct everything under the sun to win. Tax deductions scare people when they don't take them. I totally understand it. Anytime the IRS comes involved, people are like, I don't want to pay any more than I have to. Fine, if you don't want to pay any more than you have to, but you're going to miss out on the 3 houses that are going to make you a bunch of money, what's the better advantage? Getting the emotion out of it and following the math. That's what you have to do. And it is super hard, guys. I totally understand. The emotion of the IRS, it's a big deal. That's where your tax advisor is supposed to be there coaching you. And I always recommend, if you're planning on investing or you're planning on buying a house, heck, if you're planning on buying a car, knowing what the tax return means for that eventual purchase, any large purchase. Oh, and by the way, just as a side note, if you're in the middle of financing, please don't go buy something large too, because that'll screw everything up as well. How many times, I mean, I know Wade's seen this millions of times, we're closing on the house and somebody buys a boat. Well, yes. Shoot, now the boat blew up all the numbers, and you could have waited 30 days for the boat. You could have waited till we closed to get the boat. You don't want to lose your deals because of the wrong decision. Keep in communication. Your banker and your lender and your CPA are supposed to be your allies in this. We're not competing against them. We're trying to figure this problem out collaboratively.
Absolutely.
Oh, look at these guys. IRS tax deductions. So I'll tell you a little bit about my firm here, not for marketing purposes, just to explain. So we are famous for being the advisors. This is what we're known for. In fact, actually, we've started gaining national recognition because we're different. We don't focus on tax prep. In fact, actually, we don't prepare tax returns. Our entire job is to give advice. Now, we're actually a full family office. We do tax law, wealth management, and insurance. So if you are a wealthy individual and you need to figure out your estate plan and what do we do with these buildings and do we give them to my kids, that's the stuff we do. But it almost always starts with, how do I pay less in taxes? How do I minimize this? And how do I pull a fast one on the IRS? Well, hold on, you don't want to pull a fast one. You want to play within the rules, but you can be aggressive. The magic 2 words is right there in the first sentence. The IRS looks for, is it reasonable and customary that this expense exists? So let's just say you have a wedding invitation business and you make $10,000 a year making wedding invitations for people. It's not a big business, it's just a little side hustle. You're getting some cash. Is it reasonable and customary that you need to travel to Maui once a month just to make sure your client is okay? No, it's not. That is not normal when you're building paper and designs and you mail them. You don't need to fly to Maui on a $10,000 trip 10 times a year and spend $120,000 because you made 10. That's where the IRS starts to look at things. Is this normal for this type of a business? Does a general contractor need a jet ski for their business? No, they do not. You don't. I don't care how many clients you land because you tool them around the lake. There are ways to write off portions of it, but a jet ski on the books of a business is not reasonable and customary. This is where your CPA and your advisor really comes in powerful in the conversation of what is reasonable, what is customary, how far can I push this, where am I pushing it too far, understanding how that works. The IRS rules are an art. This is an art, guys. It's interpretation. Reasonable and customary does not have a specific definition. It does not have a number. It does not have a name. It's reasonable. And I will tell you, behind the scenes, the IRS does have standard templates. They don't release it. They have their audit guides. This industry typically has these percentages for advertising and marketing. The same thing applies to the real estate investor. If you've got a rental property and you have $92,000 of travel on your single family home, they're going to assume you made a decimal error. You meant $920. Sorry about that. There is a template that they use, and it's very proprietary. They don't release this stuff out there, but it's a range. It's not precise. So it's an art. We got to figure out where it is reasonable and customary to go for. Now, we have an internal rule on what's deductible. This is my rule. It's not going to find this on Google. There are 3 categories of deductions. First category is there is no way I was ever going to spend this money if it had not been for this stupid business that I have. And I keep saying business, rental properties and investments, it's a business, guys. Just because you think, well, I'm just handing off a passive, it's a business. Treat it as such, which means deductions and accountability and all that stuff. So if you did not have that single family home, you would not have paid the contractor. So that's a tax deduction. Absolutely. That's easy. That's the easy category. The second category is, well, I probably would have spent this money anyways, but I do use it a lot for the business. Can I deduct it? Your cell phone. Your cell phone is the primary point of contact that you use for your business. Now, if your employer is not paying for your cell phone, this is your cell phone, and you drop $100 a month, guess what, guys? You have a $1,200 a year tax deduction. You would have had a phone anyways, but it's your primary source of communication for this business. That's allowable. This is where we start to play the art. What is allowable? How much mileage can I take? What about those meals? That's where your advisor starts to add power. The third category of expenses, this is where the fun starts, but the risk starts. Hey, Hashan, how can I make this look like business? Because I really want to go to Vegas, but I don't want to write it off as a tax deduction. How can I make this work? Reasonable and customary. If you're flying to Vegas for a real estate investor conference and you paid $300 to attend and you're showing up the day before and the day after the event, guess what? You still got to go to Vegas, and that would be reasonable and customary. You went to go learn. You went to build your skills. Probably a tax deduction. Doesn't mean it always is, because the client that tries to fly to Europe for a real estate class, okay, we'll talk about how that works. There's specific rules on that stuff. But understanding that I would have never spent this money, that's easy. Well, I would have spent this money, but can I take it as a deduction? And how do I reposition this aggressively and knowing what the risk rewards are? I'm not telling you to write off the jet ski, but if you have a side business of a jet ski rental business, hey, guess what? It does make sense. That's the power, is understanding where category 2 and 3 fall in so that you can get there. And universally, anybody that comes in and says, I want to pay no tax, I want to pay no tax. Now, we already just covered why that could be a deal breaker for all investments in banking, right? But the client that says, I want to pay 0 tax every single year, it's unrealistic expectation. There's only one way I know how this works every single time. And feel free, if you got a pen ready, here's how this works. Whatever the net income is in your business, the amount that was about to be taxed. So we're going to say your real estate investments are about to spit off $100,000 of taxable income this year. The only way to eliminate it is you take that exact dollar amount, you write it on a check to SMD Consulting and Accounting, and you hand it to me before December 31st. Absolutely, you will pay no tax. I will bear the burden of the taxes for you. I won't give you the $100,000 back because, well, I paid the taxes on it. No one does that. You don't want to make no money. You just don't want to pay more of it to the IRS than you have to. Make the money, pay your fair share, just not more than you have to. And the final thing is, and this is just a general tip, if you're playing poker with someone and you've never played poker before, you don't know anything. You just think colors matching is kind of cute. And the other person playing with you is a poker professional. How often are you going to beat that individual? Probably never. If you don't know the rules of the game, you're not going to win. The same is true about taxes. If you don't know the rules, you're gonna waste money or you're gonna get audited, one of the two. Your advisor is there to help you with this stuff. Know the rules. You can win these games, you just have to know the rules. That's a huge part of it, and it's so lost, and this is why Google's a big giant liar, because it gives you the wrong stuff. Knowing these games puts the professional poker player on your side as opposed to opposed against you. That's how you end up winning the game.
Excellent.
So I don't know if any, Wade, you have any tax advice, Wade? Anything that you'd like to give as a strategy?
There is a slide. I thought there may be a slide coming up that we've already covered. I do have a couple other things, not so much on the tax advice piece, but just to cover a few things that I do really impact people who are wanting to continually borrow on rental properties. I think the first thing I would say is that you do need to understand the general rules associated with it. You want to depreciate those items in most instances in order to ensure that you can continue to get qualified. You do want to talk with your loan officer about what income is needed. There are some people that make enough money to where you don't have to show any income on your rental properties and you still qualify. But I would say the average person that comes to us, that is not their situation. A couple other things to keep in mind is that we do, and all other lenders that provide Fannie Freddie loans for the most part, do have an 85% LTV Freddie product, but that does involve PMI. You do need to understand what PMI is. It is private mortgage insurance, and it increases your payments until you get that LTV down to 78%. We really never encourage going above 80. We normally recommend actually doing a 75% Fannie loan because there are some advantages, especially that we have with our products. But if, as you mentioned earlier, if you are doing a 75% hard money loan and a 75% Fannie loan, you're going to have closing costs on that second transaction, which you have to keep in mind in your overall equation. Another thing is that you do have to have a 720 plus FICO score in order to do 7+ properties. That's another thing to keep in mind. On your first several properties, it's not that big of a deal, but if you are not at a 720, we need to plan ahead. Your loan officer can work through some what-if scenarios to ensure that you are doing the small things that can enable that score to get up. There's some very simple things that you can often do, including keeping your percentage of money borrowed on credit cards below a certain level, paying off maybe some small medical charge-offs or other things that may be on your credit bureau can really improve that. Couple other things to keep in mind is that you have to have two things whenever you're going to get your refinance loan on a Fannie Freddie loan. As far as cash goes, you have to have your money for going to close. That is called the assets. Those must be liquid and they must be sourced. Whenever I say source, large deposits are always going to be required to be explained and sourced. For example, whenever you are taking draws from your hard money lender, you may get a $20,000 check that comes in or a wire. You will need to provide documentation on that because it must be sourced. Fannie Freddie wants us to ensure you have not opened up another loan. As we mentioned earlier, opening up another loan would mean that you would have to add that to your debt to income ratio, which could be problematic. Another thing you have to have are reserves. And as you add properties, you have to have more in reserves. Your first 4 properties, you have to have 2% of your aggregate unpaid balances on all your mortgages as reserves. Now, that does not have to be liquid. It could be in a variety of forms, such as, it could be in an IRA, it could be in a 401k, whatever the case may be. But that number goes up as you add more properties. It goes to 4% for 5 to 6, 6% for 6 to 10. So to Sean's point earlier, as you add more properties, not only do you need more to purchase the properties, but you need more in reserves in order to qualify. So it's very important to understand that as you grow your portfolio, you want to talk regularly with your lender and your CPA to ensure that you have the cash necessary to continue to buy these properties and to refinance out. One of the things I'm going to mention as a last piece of advice is that there are many lenders out there that only do hard money. There are many lenders out there that only do the refinance transaction. And it's very important to, at minimum, have a group that's very integrated and make sure that your permanent financing lender is ensuring that you're meeting all these unique qualifications before you get the hard money loan. So you do have an exit strategy. We do provide something a little bit unique in that we have a single point of contact, as Destiny mentioned earlier. That means that your person who's providing your hard money loan is also the person providing your permanent financing loan. So it's always our requirement that we know you're approved for that exit strategy and that you understand the implications of every action and the pricing associated with it. So you do want to understand exit strategy. It's actually more important in many ways than the hard money loan, because a lot of hard money lenders just don't have the same expectations for qualifying for that loan. It's not even close. There are no debt to income ratio expectations. So it's easy to get a hard money loan. The exit strategy is the more complicated piece. So you want to understand that. Put that home under contract. That's all I have on that piece, Destiny. Do you want to open it up for questions at this point?
I do. Yes, my PowerPoint's been a little sticky, so I'm sorry for that, but I'm getting to this slide so that anybody that was interested in the contact information can get it here. This is for both us and SMD. You can add us on Facebook. That way you can make sure you don't miss our upcoming webinars. We do have another one scheduled for next Tuesday and one for next Thursday, so make sure that you register for those. And we do have quite a few people that are repeat on here, so you guys know the deal. You'll get a copy of the recorded webinar if you are able to attend or not, so that you still get that information, but you must register to receive that video. We'll go ahead and get started on the questions. I just want to say thank you, Sean. That was absolutely wonderful. So much information.
Absolutely.
Happy to help.
So I see that we had a question regarding some of the areas where we lend. We do have a page for that on our website, and we did answer it in the box so that you have that. But if there are any additional questions from anyone else regarding what areas we lend in, please feel free to shoot us an email or check out our website on areas we lend. This question is going to probably be for you, Sean. This one's from Valerie. How do you use a series LLC in the state of Texas? Is that something that you...
Yeah, so I will say, actually, series LLCs are great for real estate and if it's really just your baby. So here's the concept. When you have an LLC with a series LLC and you have all these multiple properties, some attorneys would say, what I want you to do is put an LLC for every single property. So you have 5 rental homes, there's 5 entities, and you have a holding company that owns all of those. Now, there are structures where we use this all the time and there's a reason, but it doesn't fit everybody. In doing so, you now have to form 6 companies. $300 filing fee just to form the basic. Bookkeeping, bank accounts. It just becomes this massive monster. The series LLC was intended to create, well, hang on, guys, we don't need you to form 6 companies. Form 1. Within the doctrine, you can have children. The children emulates what that other entity would be. So they actually have legal separation. What's really interesting about series LLCs is you can have different ownership mixes on those children. So there can be this ownership group of 5 people, but only 2 people participate in this one and 3 people participate in this one. That's pretty neat because it saves you that filing and formation. Here's my challenge with that. When you start involving all these other people, small business owners, despite your best efforts, are terrible at bookkeeping and accounting. Things get commingled, they get mixed. You're not trained accountants. If you accidentally start commingling things incorrectly, you actually may end up collapsing the whole monster and creating different types of risks. Also, when you have multiple ownership, the IRS says, that LLC, that series thing, we love it, also cute. Remember, we said it was cute before. But now actually you have multiple partnerships. I have 2 owners here, 3 owners here, 4 owners here. We need tax returns separate for all of those. So you save the filing, or the formation, but you didn't save the tax filing cost. So you run the risk of increasing your complexity and increasing your risk unintentionally. If this is just your baby and I'm just setting it up for separation and nobody else is playing the game with you, series are awesome. They really do create this nice liability shell, but they have complexities. Please, please, please get your lawyer and your accountant collaborating on this. The lawyers love it. It's easy. They file this bad boy and they put these documents and they do amendments as you change things. The accountant, well, we have a stroke sometimes because we're going to see the mess that goes on between this. And then you're spending thousands of dollars on cleanup if you do it wrong. So understanding the pros and cons, series are great in the right circumstances, but definitely talk to somebody ahead of time to make sure that they understand. And by the way, that's Texas. Every single state, not every state even has a series LLC, and other states may not have the same set of rules. So knowing where your jurisdiction is matters as well.
I want to add one thing to that. From a lending perspective, just to reiterate, Fannie Freddie loans, you can't borrow in entities. We do have other products that allow you to borrow in entities, but I will say, I personally made the mistake, in my opinion, of trying to start with a series LLC. It is very cumbersome. I think attorneys really like it because they make a lot of fees setting up all these different series, but the CPA is going to be an ongoing fee every year that is going to be increased by a pretty large margin in many instances. And then from a lending perspective, whatever type of product you're getting, most lenders do not like the series LLCs, and it creates a lot of extra paperwork and difficulty for you. So I've known a lot of people that tried to start doing it, and many of them shifted away just as I did. So that's my personal experience, but other people may really like it. But
and here's the challenge.
To
talk over you there. So the challenge with it too is all the people you're interacting with need to understand how it works. So Wade knows what a series LLC is. He's been around it. Is the lender you're using familiar with it? Are they going to freak out and suddenly slow the down by 6 weeks because they're trying to learn some new law that they don't understand? Having knowledge and experience in that area. And I will say series cause complexities. I'm not going to say don't ever do them, but I do lean that direction because there's other more traditional vehicles that work really, really well that don't create the complexity and confusion.
Absolutely.
So I thank you guys. I'm going in order for everyone that's waiting for their question to be answered. And Vicki and Darren, your questions are a little specific to your own circumstance. So we will email you responses on those. We're going to answer the more broad questions that would be beneficial for all parties on the webinar, but we will send you an email answering those questions. This one is going to be from Demetria. Do you help nonprofits with rehabbing properties or purchases?
That is not financing that we provide. Now, Sean may provide some advice on how they can go about that, but that is not one of the financing services we provide.
Yeah, and we actually typically don't advise nonprofits because nonprofits mean non-taxable, and there's not the value add that we have. However, I do have friends that are CPAs that specialize in advising nonprofits and the taxes, the accounting, the setup, the compliance. So if you're devoid of a resource, let me know. In fact, the guy I know is 2 buildings over from me in our office condo complex. So I know him really well, and I've sent a lot of nonprofit work over his way. So hopefully that helps.
And his email is on the screen, so write that down, okay? And this next question is from Troy. Sean, are any of your residential real estate clients taking advantage of the net operating rule change under the CARES Act? And then he follows up with, I meant to say net operating loss rules to be more clear.
In real estate, so, and this gets into like the real estate pro rules. The answer is yes and no. The net operating loss rules, just a quick paraphrase on what it means, is the IRS made the rule change on how you can carry forward losses and use them and apply them to years or carry them back. So if you have an operating business, you lost $80,000, but you can't deduct it for some reason this year, you can roll it forward or roll it back. That's the short version of this. So it's kind of a suspended loss that we want you to use it, just where and how. In real estate, most of the time, your losses are passive losses. The NOL, net operating loss, NOL rules are typically deemed for the active side versus the passive side. But the rules are very, very similar. Passive losses that you can't take are suspended and carried forward to some future date. So the answer is yes, we do, but usually what we're trying to do is reclassify passive as active so you can get them today. And then if you do end up with a pool of net operating loss that's just not getting used, we then strategically have to decide what's the best way to do it. Physician client of mine started up a brand new practice, lost $90,000 in year one because of all the equipment purchases. Totally normal, couldn't deduct them. We then decided, how do we want to handle that and what do we do with it? Do we not deduct as much this year and save it? Do we carry it forward? Oh, by the way, they own part of a surgery center. Can we use those losses? We start marrying up everything that's happening in the world. So I know it's kind of a long answer to it depends, but it does depend. Yes, we use them. It's just based on your very specific circumstances.
And I've got more questions coming in. This one is going to be from, I apologize in advance if I don't say your name correctly, but Miral Dahar. And the question is, how much of a percentage on tax planning charges are deductible expenses?
How much of a percentage? So actually, all tax planning and advice, if you have a business, is deductible. And this is a 2018 tax law change. So when they changed everything in the tax laws, your standard deduction jumped up, they stole your exemptions, and by the way, they stole your exemptions. They marketed the standard deduction, they stole your exemptions. In my household, I have 3 rugrats. 3 rugrats, 2 parents, times 4,000, that's 20,000 that I don't get to take. But they bumped me up from 12,000 to 24. So just know how that works. In the midst of all of that change, there used to be a field on your Schedule A itemized deduction where you could pay for professional fees and financial advisors and get that as a deduction. That does not exist anymore. So for the individual, it doesn't count. But if you're a real estate investor, you have an operating business, whatever your company is, that is an expense allowed as a business expense. We're back to reasonable and customary. So if you pay us $50 million because we're geniuses as tax advisors, it has to be reasonable and customary, right? If you make 40 bucks and you paid us 50 million, I'm going to thank you, and you might lose the deduction. I'll just send you cookies. But you can't really deduct all 50 million. We have to find a way to do that. But if there's a reason the fees exist and they're business expenses, totally reasonable and customary, totally deductible, and allowable in almost every single circumstance, except for individuals only that have no business to speak of.
Wonderful. Annie is going to be our next question, and she asked, what is the general charge? Well, Wade, this one might be for you. What is the general charge for reviewing an investor position in several single-family and multifamily properties?
What is the general? I'm assuming she is more talking about an accounting review. Yeah, so.
Probably so. There is no general charge. It depends on the circuit. It's complexity, right? We happen to do everything fixed fee. So we would look at what the complexity is and go, okay, it's going to be 50 million bucks or whatever the number is. If we're reviewing a PPM, that's one type of an agreement. If we're reviewing your portfolio, your organization, and like this guy that I've got his paperwork right here, we're going to change his organization. We're going to quote him on what it's going to cost to change the organization and explain the value. So there's not a fee. We don't bill by the hour. So if I'm really, really slow, you're not punished for that. I'm just slow and I eat that cost. So it's case by case basis. We do a 1-hour no charge intro. So we set up a time to call or do a Zoom meeting. Let's see what's going on. And if it feels like in that initial meeting, a lot of times we give a lot of free advice. As you guys may have noticed, I like to teach and give advice anyways. In that 1 hour, if we say, you know what, I think we can help you going forward, we'll do a document request to get an understanding of your world. And I'll pull together a proposal and go, I see what's going on here. Here's what we can do to help, and here's what it would cost to do that. The flip side, by the way, does happen. I just did this yesterday. A couple guys came in with their business. They're getting rolling. It's too soon to hire us yet. I gave them some advice and said, now call me in 3 months. Let's see where you are. But if you start spending money on me now, I'm just going to drain the coffers. So imagine you've got a single family house spitting off $300 a month. Do you really want to pay your accountants $50 million? Because I like that number right now. Do you really want to? Does that make sense? It doesn't make sense. There has to be value. And that's what we're looking at. Can we add value if we're going to tell you to hire us?
So our next question is going to be from Valmy. I understand lending is going. Sorry, my dog is barking. I'll be right back. I guess I got a package.
And see, I just my kids keep it
working from home.
Yeah. You know what though, is I think everybody's so used to the working from home thing that it doesn't bother anybody.
So sorry. Hush, grumpy dog. He's grumpy today. So this question's from Valmy. Thank you everyone for being patient. I understand lending is going to be challenging under an LLC if you are starting out as a real estate investor with a few properties. Would you discourage the use of an LLC for tax purposes? At what point would an LLC be advantageous?
So yes, Wade is 100% right. You're going to get better rates purchasing it personally. There are provisions, and this is where you have to collaborate with your lender. There are provisions where you borrow it, buy it, finance it, own it personally, and then you assign it to the LLC. You deed it over to the LLC as long as the lender approves. Now in Texas, there's a bunch of different rules. Actually, there's a Fannie Mae set of rules that allows this to happen, but there's disclosures. What most folks will do, buy it personally, assign it, and make the LLC and the original purchaser co-borrowers. You're still on the hook for the loan. You're not trying to skip out of the loan and hose the banker, but you can assign it over. When is it appropriate? Depends on what you're doing. If your entire vision is I want to have 2 rental homes, don't do it. You're going to get up a headache. You're going to irritate your banker. It's going to be frustrating when you 1031 exchange. You might not be able to borrow later. There's other consequences. If you're building an enterprise of 10 of them or 20 of them or 50 of them, yeah, absolutely, entities make a ton of sense. And then we've got to work on the coordination between the borrower and the tax implications. So my rule of thumb, total rule of thumb, doesn't apply to everybody. If we're talking about more than 3 properties, let's explore what the LLC means, what the compliance is, can you follow it, and what does it mean for your banker? Let's discuss that plan. But if you're stopping at 3, I just think spend a whole bunch more money on insurance policies. And by the way, your $1 million liability umbrella, it's not enough. One crazy tenant will sue you because their little baby girl broke her pinky toe and it costs $2 million to fix her pinky toe. When the $1 million policy pays, where's the other million come from? Everything else you own. That's why entities exist, is to stop that liability and risk. So the cost of jumping from $1 million policy to a 2 to 3 to 4, it's de minimis, guys. It just takes one deal that will bankrupt you completely because of some crazy tenant. And the worst thing possible is you have a lawyer as a tenant and then you don't have to pay anybody to sue you. So then they just go nuts. You don't know how crazy people are, but it just takes one litigious person to really, really mess up your portfolio. And that's why the LLCs exist. And the bankers don't want you losing the houses either to some other goofball. They want to protect your assets too. And that's where the collaboration comes in.
Thank you, Sean. Great answer. We have one last question, and then Wade and I both have a 1:15, so we will be jumping off as soon as this one's done. But this one's going to be from Aaron. He has a question about deductions, and he was curious what the difference is or how they fare repairs versus capital improvements to depreciate over time, kind of a general rule of thumb.
Okay, so the concept is depreciation. So when you have a capital asset, the IRS and really just the accounting rules say you want to spread the cost over the useful life of that asset. So we're going to use a computer, for example, and then I'll get to the capital specific. You buy a $1,000 computer, the IRS says that computer is going to last you 5 years. We can all laugh about if that's true or not, but what they do is you take your $1,000 computer, you chop it up into 5 little parts, and you take a $200 depreciation deduction every year. You get a deduction of $200. Now there's exceptions to that. We're not getting into that. If it's an expense, you just take the whole $1,000 today and just move on with your life. Everyone has to decide what their capitalization policy is. A few years back, the IRS passed a rule that said everything over $300 must be depreciated. And I know that sounds ridiculous. If you buy a $300 set of shelves from IKEA that's going to break in 6 months, you're supposed to depreciate it over 7 years. I'm not tracking it. It was a dumb rule. They didn't admit it was dumb, but they basically admitted it was dumb. The very next year, they said, oh, we're sorry about that. The rule is 300. By the way, we ignored it that year because it was that dumb of a rule. The next year, they said, we're sorry. The rule is 300 unless you have a verbal or written capitalization policy. Here's SMD's cheat sheet capitalization policy. Congratulations, we're giving you your verbal capitalization policy. If you spend less than $500 on something, expense it. Take it as a deduction now. I don't care. It's less than 500 bucks. If it's over $1,000, let's just depreciate it. In buildings, you add it to the basis of the building. You bought your building for 125, now it's 126, and then 127. If it's between 500 and 1,000, totally your decision. I don't care. I'm not gonna say I don't care. You decide. It's a judgment call window. Now, the bigger your asset, the more those numbers shift. But for a lot of small business owners, this gives a really wonderful cheat sheet guide. If you're spending $1,000 on something, it probably has some material value. You might as well capitalize it. Now, in single family and multifamily real estate, you're depreciating it over 27.5 years. So you're chopping it up into lots of little tiny parts, so your deduction is less. But this comes back to what Wade said. You're spreading it out, but that shows greater profitability. It shows a better asset with a higher value. It shows better cash flow. There's an advantage to doing it. And this is where, well, I want to expense all $1,500, Sean. Cool. Do you understand the consequence to your lending side? Do you mind? I'm happy to get you your $1,500. Let's make your capitalization policy $1,500 or greater. Better to write it down, but that's our rule of thumb, starting point capitalization policy to fight this ridiculous $300 rule that the IRS mandated. And by the way, you can blame FedEx for the reason why they came up with this ridiculous rule. Because see, FedEx would buy turbines for their jet planes. They buy a plane engine for millions and millions of dollars and go, that's a repair cost. We're going to expense that. $10 million turbine, $10 million deduction. The IRS went, no, that's an asset. Come on, it's 10 million bucks, guys. It's not an expense. A stapler is an expense. A foundation to a property is capitalization. And that's what we're trying to do, to play the extremes and understand that. But the dollars decide, not the asset itself. So you got all kinds of accounting nerd stuff right there. That went deep. I didn't even code section you. I just went, but that was some accounting class.
All right. Well, thank you so much, Sean, for having you. It was wonderful. We learned a lot. And I did get 2 questions that I think I'll copy you in an email with Wade that we could respond to. It's more individually, it's more of an individual question, so I don't think it would benefit the group. But everyone that stayed on, thank you so much for joining us. Remember to check us out on social media. If you're interested in Sean's contact information, it is below, so take advantage of that. And we'll see you guys next week.
Thanks, guys. Appreciate it.
Thanks, everybody. Thanks, Sean.